Let's bring in our panel. We've got Rakeen Mabud, who is the Groundwork Collaborative Chief Economist, Managing Director of Policy Research. Also with us, we've got Teresa, Ghilarducci, Professor of Economics and Policy Analysis at the New School, and Danielle Twiss, an MA candidate from the New School. Great to have you all here with us in studio this morning.
Thank you, Brett.
So we've got the numbers here on the desk with us, and starting to really dive further into some of the details here. Rakeen, would just love to get your take off of some of the headline figures that we've seen thus far, and perhaps some of those pockets that really stick out from this report.
Yeah, I mean, to me, what sticks out in this report is the fact that, inflation is sticking around and whatever the Fed is doing is not working. Mm-hmm. And the reason it's not working is because the tools that the Fed has to address high prices don't actually get at the core root causes of what's causing today's inflation. We have corporate profiteering, we have supply chain issues, we have geopolitical factors, and some of these issues have started to moderate. I mean, supply chains have started to ease, but the fact of the matter is the Fed, through its 10 consecutive interest rate hikes, and we'll see what they do tomorrow, have simply been hammering away at the labor market and really trying to weaken a labor market that has been remarkably strong coming out of the pandemic. And so I think we really need to take a different approach, and the Fed not only should pause tomorrow, but really pause going forward and see these 10 rate hikes play out.
Teresa, what do you think here? I mean, the Fed's traditional method of tamping down inflation is trying to tamp down demand. Yeah. Is that part working?
Well, I completely agree with you and with Rakeen. They're really operating on these very old theories, and also the present day fact that they're given some authority in a place where they don't have any tools or effectiveness. So they're given this huge hammer of interest rates. Interest rates for mortgages, depending upon the way you look at it, is the highest it's been in a couple of decades. So they're hammering the housing market, but the theory says to hammer workers, hammer workers, hammer workers. This old idea that workers are pushing up wages, and then passively the companies just have to push up prices because what's a company to do. When in fact that's not happening. Last year, workers' wages was tight and did go up. We did see some nominal wage increases, but only 4.3%. Whereas prices went past that 4.7, 4.9, and we see it today. So workers are actually helping keep down prices because their productivity and their wages are helping companies be productive. So we're asking the Fed to do too much. They've gone too far. They've actually created some crisis in the banking sector. That was something their risk management officers should have figured out. What is a sudden rate hike going to do the balance sheet of Silicon Valley Bank? So for sure, tomorrow they should pause, and we should look at other sectors of our regulatory system that could help consumers and everyday people, like Danielle.
Well, and Danielle, even within this, even as we think about some of those wages and how that's been factored into prices, I mean, it's important for us to remember, too, that wages are still well above where, at least in the growth, as that's starting to come down in wage growth, we're still seeing wages that are above some of the averages pre-pandemic times. And so with that, the prices, as businesses would say, they're going to continue to remain elevated as long as they can pass that through in a demand environment like this.
So I think the key thing is that prices are increasing at a rate that's higher than wages are. Mm-hmm. And wages started a couple years ago at a floor that was already too low for workers to afford their basic necessities in cities like this. And so when food and shelter, which is what workers are primarily spending their money on, are increasing at 6.6, 6.7%, and wages are seeing an increase of only 4.3, that's a real wage decrease. And so for working people, this is actually a decrease in their standard of living and a huge increase in their cost of living.
And I think people understand that sort of instinctively, even if they don't understand, right? They know what's happening in their checking account, right? Yeah. If they have a checking account, right? They know that they're getting squeezed when they're going to the grocery store, et cetera. We have seen something of an increase in worker negotiating power over this period of time. For the first time in a long time, we've heard a lot more union talk, for example. We've got the writer's strike, for example, going on right now. How long does that continue, Rakeen? How, if indeed the labor market weakens, do workers retain any of that power?
No, I think that is such a critical question. And just to double click on something that my colleagues have said, wages going up is a really good thing, right? People having more money in their pockets is a good thing for our economy. We all make the economy go. We should have more money. We keep the economy running. And we have seen over the course of the last couple of years, tight labor markets really bringing more and more workers into the economy. We saw 2 months ago, black unemployment drop below 5%, which has never happened in the data before. That is a remarkable achievement coming out of a pandemic. We have seen disabled workers, other marginalized workers really starting to see the benefits of a tight labor market. And with that comes an increase in power and agency and people able to demand what they deserve on the job, which is a good quality job, good wages. Look, the Fed is on a mission to destroy all that. That is the truth of the matter, right? They have put in 10 rate hikes into the system.
Well, but okay, to play the devil's advocate a little bit, to destroy all that, I mean, inflation is not helpful for people either. Non-wage inflation is not helpful for people either. And the Fed's mandate is to bring down inflation. So, wage inflation doesn't exist in a vacuum. You can say what you will about companies maybe taking margin, which is what publicly traded companies do. It's their mandate to do that to some degree as well. But you can't. Can you divorce? I guess the question is, can you divorce wage inflation from other types of inflation?
Yeah, no, you can't. But the Fed has to understand that wages and workers are not pushing up inflation, and they're smart, and I think they do, but they only have the one tool, which is interest rates. They're really hammering the housing market, and that's why today and last month we saw shelter prices increase so much. Mm-hmm. So they could take a pause to take a break on what they're doing to the housing market. I wish that tight labor markets were the only thing that workers needed to have some power. Yes, that brings in added workers, but for unions to get a wage increase that exceeds or even matches inflation, we're not going to see that anytime soon. The anti-union laws, are really hurting unions that might form in the new Inflation Reduction Act, the microchip companies, is mainly being built in the South. The big Taiwanese companies coming to Arizona, they're not organizing anytime soon.
And I think to get the full picture of labor unions at the moment, we also need to take into account this profit-led inflation, because when we have profit margins of 14-15%, which is record profit margins that we haven't seen in decades, then if we look at this from a lens of class power, workers are actually in a really bad position. And so to me and to other people that I work with in union organizing, the solution is actually increasing worker power. So to combat inflation that's profit-led, that actually means more worker organizing and more worker power. That's the solution.
I want to thank you all. Unfortunately, we have to leave it there. Thank you so much for being here. Rakeen Mabud is Groundwork Collaborative Chief Economist and Managing Director of Policy Research. Teresa Ghilarducci, Professor of Economics and Policy Analysis at the New School. And Danielle Twiss, an MA candidate from the New School as well. Thank you all so much. Really appreciate it.